What's up, guys? The past 2 weeks have been filled with devastating news about the crypto industry, starting with a shocking revelation on FTX. So in today's video, I'll be talking about the crash, talking about the event that led to the crash and what could have been done to avoid this crash. And if you stick to the end of this video, I'm going to talk about 10 things to do to avoid being scammed by exchanges. Now, before I continue on this video, I want you to note that this is not a financial advice. I am just not a financial advisor. This video is for educational and entertainment purposes only. So if this is your first time on this channel, welcome to Crypto Sage. Don't forget to subscribe to our channel, to turn on the bell button so as to get notified when we drop a new video. And if you are not a subscriber, I want to welcome you again. Don't forget to like, comment, share, and tap the link below to follow our Twitter page. So without further ado, let's go straight into the video. So first off, let's talk about FTX. Now, FTX is a cryptocurrency exchange that was launched in May 2019 and became one of the largest crypto exchanges in just 2 years with a valuation of $32 billion. Now, at the center of it all is its founder, Sam Bankman-Fried, popularly known as SBF, the young billionaire who is now broke, from being initially worth close to 16 billion to currently worth nearly zero, unless he had some cash in his pocket when the crash happened. Now, you may wonder, how will a $32 billion exchange just collapse? Now, this takes us to the cause of the FTX crash. Now, the answer to this question lies in a token called FTT. You may have heard of this token, FTT. This is the token of the FTX exchange. Just like how many cryptos would create their token, FTX exchange was not left behind. It created a token called FTT. Now, in case you're wondering what an exchange is, a crypto exchange is a website where users can buy and sell cryptocurrencies. Another cool thing an exchange can do is to create native currencies, which is like printing money out of thin air, and that is what FTX, a crypto exchange, did. They created their own token, FTT. With aggressive marketing, low trading fees, celebrity endorsement, and many others, FTX became very hard to miss. But things began to change gradually when the balance sheet of a crypto investor firm that was also owned by SBF, called the Alameda Research, was published by CoinDesk. Now, CoinDesk is a crypto-focused digital media website. Now, it shows that this research had a large amount of FTT. Now, although the FTT had a certain market value, if the price were to drop, Alameda would be at risk of insolvency. Now, Binance founder Champagne Zhao, popularly known as CZ, one of FTX's first investors, stepped in to make a play for his former rival. On November 8th, he announced that Binance would purchase FTX for an undisclosed amount in what would essentially constitute a bailout for the firm. But Binance quickly backed out. The founder that FTX had mismanaged users' funds. Now, CZ on November 6th says that its company would sell off its FTT tokens. The price of FTT began to drop immediately, he says so. Now, as the price dropped, many FTX customers moved to withdraw their assets from the platform. On November 8th, FTX stopped allowing customers to take money out of the platform. Wow. On November 11th, Bankman-Fried stepped down as CEO of FTX, and the companies he oversaw filed for bankruptcy. Now, as rumors show, it was heard that FTX needed $8 billion to cover the gap between what it owed and what it could pay out. Wow. This was actually a huge one. Well, as they always say, one shouldn't cry over a spilled milk. Instead, we should be looking for a solution on how to remove the backdators from the crypto sphere, especially the centralized one. So this takes us to another question: how to prevent the next FTT, or FTX rather. To prevent the next FTX, I think firstly, financial regulators and industry leaders should move towards what is known as proof of reserve. That should be the first step. This means that large centralized exchanges and custodians have to prove their assets and liabilities. In other words, they cannot badly assert that they possess $1 billion in customer funds while quietly using those funds to make other risky investments and loans. So before you can trust any exchange, you should have proved that users' funds are safe. Now, secondly, the industry needs to step up in terms of self-policing. Now, in traditional finance, there are groups known as self-regulatory organizations that have the power to establish and enforce industry standards. No such body yet exists concerning cryptocurrencies, especially for centralized exchanges. Although several trade associations that have emerged in Washington are doing good work and might join forces on this. So these are the two ways I think the next FTX can be prevented. Yeah, you see, the explosive collapse of crypto exchange FTX has sent shockwaves throughout the industry and cost up a million investors and awful lots of money. Yeah, even if you aren't affected by the meltdown, you can still learn from them to avoid being robbed by a scam exchange like FTX. So this takes us to the last part of the video. I want to talk about 10 ways to avoid being robbed by scam exchange like FTX. Yeah, the first step is to beware of false prophets. Yeah, I want you to go online and search for SBF to see his picture. Yeah, the point here is that he looks so innocent while he preached about the freedom the crypto could bring to the world of finance by making expensive ads to push for crypto adoption, but secretly taking user funds and buying nice condos in the Bahamas. Yeah, what's the catch here? If you want to put your money on that exchange, you have to check if the exchange is spending more money than it makes on ads, because that is what FTX did and was doing, to spend millions of dollars on ads in a bear market. So you want to make sure of false prophets. Now the first thing to do is not to follow after the crowd. Do your own research. So just as investors rushed to praise SBF before the crash, now they are rushing to bury him. Wow. This is yet another warning of the dangers of following after the crowd. Stick to what you understand, guys. Stick to what you understand. The third thing to do is to ignore ads and do your own research. In short, DIY. Yeah, just the way you wouldn't take fashion tips from a crypto investors, that is how you wouldn't take investment tip from a celebrity. Yet that is exactly what people did with FTX, which was endorsed by A-list celebrities. All were skilled in their choosing feeds, but that wasn't finance. Yeah, they are now being sued for $11 billion in a class action lawsuit brought by disgruntled investors. Yeah, with luck, that will make other celebrities think twice about handing out investment advice. So guys, the check is this: make sure to always do your own research before taking an investment, making an investment decision in cryptocurrency. Make sure to do your own careful analysis. Yeah, the fourth thing is trust matters. Trust matters. Yeah, this seems like an old-fashioned concept, but without this, we are actually lost. Yes, we are actually lost. Yeah, FTX was a household named among retail traders in often opaque crypto markets. Yeah, likewise, institutions trusted the exchange as a trustworthy, ethical counterparty in the space. Yeah, even US lawmakers had a positive view of SBF from its aggressive lobbying efforts and willingness to explain the nuances of the crypto industry. All of this trust has been destroyed, leaving behind massive financial losses and extreme cynicism towards crypto markets. Yeah, it might take months, if not years, for the trauma to heal. Yeah, I particularly like this fifth one. Beware of people who claim to do good, guys. Do not be fooled. Yeah, SBF followed a creed called Effective Altruism, whose adherents pledge to give away as much of their wealth as they can, and that is what SBF did. Yeah, today many believe his high-minded claims helped to deflate criticism and scrutiny from how he was making that money in the first place. So guys, do not be fooled at all. Beware of such kind of people. Yeah, the sixth thing to do is not to borrow to invest. You see, investing in money you don't have, known as leverage, can be a respectable strategy in the right hand, but guys, it is always risky. Yeah, this is particularly so in the case of FTX, which created its cryptocurrency FTT, then used it as a collateral to raise loans. Yet FTT had no actual value aside from a promise by FTX to buy any tokens for $22. You see, money has become so expensive and harder to come by, and that makes things very tricky for those who need to borrow to stay solvent. So guys, do not be tricked. Don't borrow to invest. Yeah, the seventh point is that there is a point to regulation. If you buy an unregulated asset like crypto, you are on your own if something goes wrong. Yeah, FTX clients can't withdraw their funds from the exchange, and that is, wow, a big loss to them, and I'm very, very sorry. Yeah, in a world with no regulator, it will be difficult to get any recourse on cryptocurrency losses. At least if you buy a regulated investment and feel cheated, you have some hope of redress. So guys, be careful. Yeah, the number 8 way to avoid being scammed is to know how to spot the bubbles in the crypto market. Yeah, all bubbles, they have similarities, so it could be easy for you to spot. Yeah, the starting point for a bubble is a new investment opportunity, one that may be genuine, or even one with just a big enough grain of truth to be irresistible to those looking for a quick financial killing. Yeah, it could be anything from railways to cryptocurrencies, and the more disruptive or revolutionary it seems, the better. Yeah, this may actually help you to identify the next one, but it may prove difficult to resist at times. So guys, be smart, know how to spot the bubbles. The ninth way is that you need to know that centralization scales fast, while decentralization, it doesn't. Yeah, one of the biggest selling points of crypto is that it is decentralized, trustless, and permissionless. This was meant to provide an alternative to existing financial institutions, yet the crypto industry has quickly centralized while still marketing itself as decentralized. Yeah, FTX was a centralized exchange, much like the other big ones like Binance and Coinbase. Over 90% of crypto transactions are done through centralized exchanges. But you may wonder, why this move to centralization? The answer is actually simple. It is easier to scale centralized entities than decentralized ones. Yeah, decentralized exchanges are clunky, they are slow, they have high transaction costs. Yeah, in the Wild West of crypto, centralized exchanges have been able to increase demand for crypto and transaction activities much more than decentralized exchanges. Yeah, all the VC money has therefore gone to centralization, which has a clearer route to monetization. And lastly, there should be more proof of reserve, as I've earlier said in the beginning of this video. Yeah, there's a long established infrastructure of auditors, lawyers, and compliance officers that verify the balance sheet of financial entities, but crypto, being crypto, is reinventing the wheel with each version. The latest is proof of reserve, as I've earlier said, where exchanges publicly attest to which reserve they hold. Yeah, if you've lost your money to this crash, the FTX crash, from Crypto Sage, we're actually very, very sorry for your loss, and we hope that you get justice for your loss. This is not actually the end of crypto, but the effect will be felt for some time. So as we continue to sail through the ocean of opportunities in crypto, we should try as much as possible to safeguard our money and do our diligent research to remain safe. And that will be all for today's video, guys. If you've enjoyed this video from the beginning to the end, make sure to subscribe, to like, to comment, and share this video. Crypto Sage signing out.